So Europe's finance ministers met on Sunday to discuss aid options for Greece. They deferred a final decision on the next installment payment of its bailout until early July and are putting some pressure on the Prime Minister and the Parliament to adopt a new wave of austerity measures. As you know, that's been met with much resistance and protests. Are these plans, are they going to provide Greece with a long-term solution to its debt crisis? And really, what's going to help prevent the negative effects of possible default from spreading to other world markets?
Oh boy, well there are several questions there. So the short answer to your question is no. What is afoot right now will not provide a long-term solution. It just simply buys a little bit of time, and not very much, as a matter of fact. So let's review the events here just to set the stage a little bit. A year ago, the IMF, International Monetary Fund, and the European Central Bank put together a 110 billion euro package to provide funding for the Greek government to help them, give them time to get their house in order. And Greece enacted what's called fiscal consolidation, or austerity, if you will, programs that cut government employment, changed the pension rules, and reduced wages, a lot of stuff. But the whole intent was to get the budget deficit down. And it was understood that that would require time to accomplish, and for a period of time that the Greek deficit would come down, but the debt to GDP ratio, which is a measure of burden, debt burden, would actually go up. And that, of course, that's exactly what happened. What the assumptions, and I said this at the time in a letter that I wrote a year ago, I said the assumptions were far too optimistic, because for that solution to work required the Greek economy actually to begin growing, so that you would have growth in the GDP part of the debt to GDP ratio actually increasing, so you would shrink the impact of the debt burden. In fact, the outcome is far worse. Unemployment has gone up more than forecast, GDP has gone down more than forecast, and so the debt to GDP ratio simply exploded. And the deficit has not come down as much as expected, because if you have a shrinking economy, guess what happens? Fewer tax revenues.
Right.
All right, so austerity in a situation where the economy is contracting actually adds fuel to the fire in the wrong kind of way. And it's actually created additional contractionary impetus in the Greek economy. So that's the backdrop. Now, coming up to what the finance ministers of the European Union did was simply, what's now hanging fire is the last installment on that original 110 euro plan. It's 12 billion euros. And it's just simply releasing that, and what was set up in the original plan was a requirement that certain benchmarks would be hit. Well, they really haven't been met. And so the Greek government has now been prevailed upon, forced, it might be a more appropriate word, to come up with additional austerity measures. And so what is pending right now is a package that would further increase taxes, that would include additional wage cuts, and would mandate the sale of about $70 billion worth of state-owned companies or industries. And again, that's probably, in my opinion, based on optimistic assumptions, but it would, at least on paper, put Greece back on this pace to actually be in compliance with the original requirements. And what's happening today, and this, we're taping this on June the 21st, is the Greek Parliament is doing a vote of confidence on the Prime Minister, George Papandreou, and that's expected that he will get the vote of confidence. There doesn't seem to be too much doubt about that. If he doesn't, that would be a surprise. Of course, by the time this is aired, we'll know that.
We'll know.
But if he doesn't, you know, all hell breaks loose, because that means the government falls, you have to have a new election and so forth.
Right.
Or maybe not a new election, but you have to form a new government. So that's likely, he's likely to get the vote of confidence. Then next Tuesday, which would be would be June 28th, I believe it would be, is the date that's scheduled for the Parliament actually to take action on this additional austerity program. And again, that's expected to pass. If you look at the polls, and you cited the riots and the work stoppages and so forth, this is not a popular action.
No.
It's not a popular action, but it's one where really the politicians don't have any choice. So what is Greece's problem? I think it'd probably be useful to talk about. Oh, before I go into that, essentially all this action would simply release the 12 billion euros.
And not very much else.
And it wouldn't do anything else, which is why I said no to your question. But it would give them another 2 months.
Which isn't that much time.
Another 2 months is until September, but what happens in September is you have massive amounts of Greek debt rolling over that has to be refinanced. And because they will continue on net, the deficit's still running at a level that they need additional financing over time. They'll still have to go out for incremental financing, so rollover and incremental financing. And it's estimated by those who ought to know that Greece probably needs a new bailout package in the vicinity of 100 billion euros. All right, so the 110 is just the first stop.
That's just
and
the
there's
first.
another 100. Well, all right, so what is Greece's problem, and why does this kind of go on as it is? Well, it started with the deficit was far too high, and Greece let its debt to GDP ratio get out of control, or just got up to the point. And when you cross over a certain threshold, it actually becomes counterproductive because people then worry about default. They raise your interest rates, and that actually accelerates the cost of the debt and the debt burden. The measures to reduce the deficit, in effect, have been self-defeating because they've depressed the economy, reduced revenues, reduced economic growth, reduced GDP, and so you get to a certain point again, and Greece has clearly crossed over into that zone where the remedies are actually worse than create a worse outcome. So the second problem that they have, and they actually have two problems. So the first problem is the debt problem. The second problem is the Greek economy is not competitive as a trading partner within the European Union or elsewhere. And that problem could be solved if they were not a member of the European Union simply by devaluing the currency. Because in one fell swoop, they could then reset the bar, so to speak, in terms of international trade by just changing the value of their currency. Well, they can't do that because they're a member of the European Union, so that's not available. The austerity programs will eventually help cure the competitiveness by driving down wages and so forth, but it's a very painful, extended process. The solution to the first problem, it's obvious, but it's not politically palatable yet to speak about it in a serious way, and that the solution is to restructure the debt. And what does that mean? It just simply means reducing the value by forcing all the current debt holders to take a haircut. And indeed, if you look at the yield on the 2-year Greek debt, it suggests that that haircut, the market is expecting it to be about 50%. All right, so you get half your money back. Well, what's the real issue then? Because I think we get there, that there's no alternative. Eventually you have to restructure the debt because you just can't, through these other measures, get to where it needs to be got. And the political consequences will get greater and greater in Greece, and eventually it will force the debt restructuring issue. So the real issue then in debt restructuring is who bears the loss, all right? And that's a big deal, because the answer to the question will determine whether or not we have a Lehman type of market panic.
Right.
All right. And it is probably useful just to go back and say, why did we have such a severe panic after Lehman? Well, the reason we did is that the market was expecting Lehman to get bailed out just as it happened to other significant financial institutions that had gotten into trouble, like Bear Stearns or Fannie Mae and Freddie Mac and so
Right.
forth. And when that didn't happen, it was a shock. It wasn't that it wasn't totally out of the realm of possibility. It just
It was just
wasn't.
surprising.
It was surprising
Right.
that the government actually let it go.
Right.
And the first thing you do when you are hit with an unexpected event is, oh my gosh, somebody's going to take some losses, and it's not going to be the government taking care of it. And let's just get out of anything that looks the least bit risky and not worry about it, because we don't want to be the last person standing.
Right.
Because the last person standing may have to eat it all.
Yeah.
All right. And so that's what panics are all about. And could that happen in the Greek situation? Absolutely. It could happen if, indeed, you get down to the moment of critical crisis where the can can't be kicked down the road any further, that debt restructuring has to be done, and the market is surprised by a solution that forces investors to bear some of the risk. Because investors right now, by and large, assuming for the most part, that's at the end of the day, the European Union will blink and it will absorb the debt and take over the debt, basically bail out Greece.
Right.
All right. So why hasn't that happened so far, if that's sort of where it's headed? Well, there's a couple of reasons. First of all, having talk about the European Union absorbing the debt, and there's been a little chatter about issuing Euro bonds and things like that, but it hasn't been very serious, and it definitely hasn't come from government sources. Well, why would that be? First of all, you want to keep Greece feet to the fire, because if you begin to hint that we'll bail you out, we'll take care of you, then it takes away the political impetus within Greece to actually solve their own problems. And so acting prematurely to have that discussion, it can be self-defeating. So that's one of the reasons. But probably the more important one, and I'm going to pick on Germany at this point, and Angela Merkel, who's the chancellor. Bailing out Greece is simply very politically unpopular in Germany, and Germany would bear the brunt of the bailout, because simply if the Greek debt is made whole and it shifts to the European Union, Germany is the anchor. France is close behind, but Germany is the anchor to the European Union, and essentially it would mean that the German taxpayers are bailing most of the pain of solving Greece's problem. That is not a popular position, and it could cost Ms. Merkel her job.
Yep,
All
absolutely.
right? So she certainly is not anxious to do it too, and the kick the can down the road strategy then serves both purposes, to keep Greece's feet to the fire, but also to put off the day of reckoning. But stay tuned. The next episode is near at hand. It will come in September. This is not over, and it's not going to get better with the passage of time.
Right. We will see what happens. Now, what about the threat of contagion at this point?
Well, again, it comes back to, will the market be surprised? And there's been a little bit of talk during this latest round about so-called debt reprofiling, which is a technical term for inducing current holders of debt when it comes time to redeem their holdings, and there's a lot of that coming, to simply accept new debt for a much longer maturity. Now, there's a problem with that. The problem with that has to do with the development of credit default swaps. And there are a lot of credit default swaps that have been written on Greek debt. And the way in which the contracts are written is, if the holder of the debt exchanges it for a new issue of longer maturity, and it doesn't meet certain, quote, voluntary stipulations, it becomes an event of default. And it triggers the payment of the credit default swap. And the rating agencies have pointed out that, and essentially said that if that occurs, they will be forced to say, no matter what might have happened in terms of, quote, voluntary activity, that it would be an event of default. and would trigger the credit default swaps.
Right.
But that in and of itself would get into this beginning to say, oops, now you're pushing back on the private sector through the credit default swaps, the insurers, some of the burden. And again, that becomes something that could happen. Everybody knows that, but really is not expected to happen. And that starts the trade in motion. So again, markets panic when they fear that the rules of the game are suddenly changed and that they're very vulnerable.
Yep.
And to ask no questions, just act. And the contagion occurs because you get it then moving very quickly and at lightning speed from one market to another. So if contagion were to occur, it would start, of course, with the Greek debt, but it would move very quickly to Ireland, Portugal, Spain, Italy, and even Belgium.
Which would be
And you would have something that could well look like what happened in the fall of 2008 in the United States when you had the Lehman event and the markets seized up.
Okay, well, we will certainly stay tuned.
It's not something I expect, because I really do think that the stakes are so high here, and the knowledge from what happened around Lehman is still fresh in everybody's mind, that you will have irrational resolution. But it's one where, as long as you can kind of delay it, that seems to be the favored political strategy of the moment.
Right. Let's kick the can down the road a little bit further until we need to stop.
My message is time is running out, the clock is ticking, and things are getting worse, not better.
Right. I agree. Well, thank you so much for joining us here today, and I will speak to you next month.
Great.